Hey guys, what's up? I'm Erin and welcome back to the channel. Today I have a very special guest on the channel. His name is Ed Slott, and perhaps you've heard of him. He is America's IRA expert. He's America's leading CPA. He's the gentleman who's essentially the advisor to the financial advisors or to the certified financial planners. He goes around teaching smart tax strategies so they can in turn save their clients money. Today we do a deep dive conversation going over what you can do to protect your investments, how you can minimize your lifetime tax burden. So let's see what he has to say. So today we are joined with Ed Slott, who is known as America's IRA expert. He is an expert in tax planning and retirement prep. So thank you so much for being with us, Ed.
Great to be with you and to meet you, Erin. Thank you.
Nice to meet you too. So to start off, you've been sounding the alarm about retirement tax traps for years. What do you think most people still misunderstand about retirement and taxes?
I think the simplest one is most people think their retirement account belongs to them. They don't know they have a silent or not so silent partner. I always say your IRA, for example, your IRA is an IOU to the IRS. Or to put it another way, it's a joint account with Uncle Sam. That's how most people understand it better. Most people understand when I talk about joint accounts, they might say in programs, oh, you mean like husband and wife, 50-50? Not exactly. Uncle Sam is a special kind of joint owner. He's a special kind because he can determine what his percentage might be just when you'll need the money most in retirement. Who knows how high taxes maybe it will be when you reach in for yours in retirement. Uncle Sam might say, you know what, none of this 50-50. I think we need 60% or 70%. I doubt that's going to happen. You'd have a revolution. But if you look back at the history of tax rates, for years, the baby boomer years, people like me born 1946 through 1964, the top, just as a frame of reference, not that we're going back there, but a frame of reference, the top federal tax rate for each of those baby boomer years exceeded 90%. It's not even believable. 90%, except for the last year, 1964, when the top federal rate was dropped down to only, I'm told, because I was 10 years old in 1964 watching the Beatles on Ed Sullivan, but I'm told that in 1964, when they dropped the federal rate down to only 77%, the whole country did a happy dance. Oh, wow, only 77% in taxes. And that's just federal, not state. So I say that as a frame of reference because most people don't realize how heavily taxed these accounts can be. It may not be all yours. You may not even be a partner, an equal partner on your own retirement savings. I think that's the number one thing people don't understand because they can't comprehend it. Even my own clients, when I was doing public accounting, right at this same desk here, I used to have clients, they used to love, I remember this one guy, he was so proud, a client of mine, he came in with his statement, his IRA statement. He said, Ed, look at this, I've got $1 million, I hit $1 million in my IRA. And I said, give me that. That's not your money. That's just temporarily on your letterhead. You're not keeping any of this. And I went and wrote on it, just like I told you. Your name, let's say his name was Jim Smith. Jim Smith, and I wrote, and Uncle Sam, joint owner. It's a joint account. What do you mean? Yeah, this money has not yet been taxed. So people like to see these account balances increasing, but it may not be, a good chunk of it will not go back to them in retirement.
I hear you on that one. It's kind of like we enter into the partnership without knowing the full rules.
Yeah, like getting into a marriage quickly. Yeah, it's the same thing. Because people are just taught the wrong way. Just keep piling up in a retirement account. And that was okay for years, but it's not working that well now because tax rates are an all-time low. You want to get that money out while it's low. So I'm worried. I gave you the history of tax rates. Not that I said we would go back there. It would be draconian. But there's a saying, I think Mark Twain said, history doesn't repeat itself, but it rhymes.
Yeah.
Or another way to say that, those who don't learn from history are bound to repeat it.
Absolutely. And I think that kind of segues into, you've called IRAs the ticking time bomb.
Right.
So can you explain what you mean by that? And are there some steps people can take to
Yes.
avoid this?
All right. First, why I called it the ticking tax time bomb years ago, almost 30 years ago, I've been saying it. Ticking tax time bomb because, as I said, you're building up an account that is loaded with taxes. You want the tax laws working for you, not against you. You're building up and accumulating a taxable account. It's actually a debt. Like I said before, your IRA is an IOU to the IRS. You're like adding to your mortgage on the IRA. Is that a good plan to keep adding to the mortgage, say on your home, or adding to a mortgage? Every time you put in, you say, oh, wow, I'm saving for retirement. In fact, here, I saw this. I don't know if you saw this in the Sunday Times. This was June 29th. A couple of days ago from when we recorded this. Had you seen this piece in the Sunday Times business section? All about younger people discover the fountain of compound interest and how they're putting more money into the wrong places. They think they're doing great because they're putting more money into a 401k and an IRA, but they're putting money into a ticking tax time bomb. Say that 3 times fast. They're building a debt that will have to be repaid, and most people don't realize that. So I've been calling it the ticking tax time bomb because it's a growing, accumulating, snowballing debt. I use the analogy many times in programs. I say, you know, there's a saying, I think it was Einstein has famously said, compound interest is the 8th wonder of the world. But there was a second part to that saying that's not as well known. He said, he who understands it earns it. He who doesn't pays it. What he meant there is the math on compounding doesn't discriminate. Yes, it's great. When you have money earning money, it's compounding. But when you have debt, it works the same way. It compounds. Here's an example. You get a credit card bill. Maybe you have an Amex bill, and it's, you owe $3,000. But they say, wait, don't worry about that. The minimum payment is only $41. Oh, that's a great deal. I'll pay only the $41. Well, in 3 months, you'll probably owe $100,000. So, you know, it's the same idea. It's compounding against you. You want the tax code, your tax rules, your retirement savings compounding for you, not against you.
Absolutely. And what are the steps that people can take to avoid this blowing up in their face?
Oh, you're coming into my favorite thing in the world, the Roth IRA. First, there's certain ways to always have the most money. And I do lots of interviews, and I see lots of interviews like on CNBC, and nobody can give people a straight answer because they're mostly about stocks and investing, and most people don't know anything about that, or it's guessing, speculation. Even the experts they have, well, it could be, would be, and they all give these wishy-washy answers. You know, well, could be, would be, probably, maybe, who knows, we have to run the numbers. I always give certain things what I call my always rules that are always true, non-negotiable, take them to the bank. And the number one always rule for me is tax-free is always better. There is no question about that. Tax-free is always better. You always keep more of your hard-earned money. And it comes down to sharing. You don't have to share your money with Uncle Sam. You'll always keep more. Tax-free, anything growing tax-free will grow the fastest because it's not eroded by current or future taxes. You actually keep 100% of your money. You know that joint account I talked about? Cross out Uncle Sam. Now it's 100% yours. Wouldn't you like to have that kind of an account?
Any day of the week.
It's, where do I sign, right?
Yes.
Yeah, it's called a Roth IRA. That's what I was leading up to. And I'm a big fan of Roth IRAs because I don't like sharing, especially with Uncle Sam. And I don't know if you know this, he's not even your real uncle. So there's no obligation to overshare. So I'm not a big sharer. I love tax-free, so I always err on the side of getting it tax-free. And that's what the Roth does. So if the Roth is the greatest account on earth, it's the Holy Grail, the promised land, everything in there grows income tax-free for the rest of your life. You're in total control, and even 10 years beyond to beneficiaries under these latest Secure Act rules. So if it's, here's your next question. If it's the greatest account ever created, why doesn't everybody have it?
Yeah.
Well, it's a catch. You have to pay money up front to get it. Like anything good in life, you have to look at the long-term big picture. So take this article where almost every young person, I don't know if you find this the same thing, you do a lot of shows, you talk to young people, they highlight this young girl, 23 years old, already piling money away in her 401k. This is the problem. I think virtually every company, when you're a new employee, especially in your 20s and 30s, they have a 401k and they default you right into the 401k. This person should have been, they talk about compounding, that was in the title, the compound, young people discover the fountain of compound interest. This was in the New York Times if you want to look it up. The first thing I saw, I said, that's all wrong. They're compounding against themselves. They should be opting for a Roth 401k at their job. To me, that should be the default. And according to the latest statistics from Fidelity, who runs a lot of these plans, 93% of plans and most companies do have a Roth 401k option. Why are people putting gasoline on the fire, growing their debt? They're better off starting out. First of all, every young person, this is another always rule, it's a slam dunk, should only be doing a Roth IRA. Why would anybody, now that they're available, start building a taxable account? So here's the pushback sometimes I get from advisors when I say, they should do Roth 401ks rather than 401ks. So again, most advisors, short-sighted, even my colleagues, the CPAs, they say, but Ed, what about the tax deduction? And that drives me nuts because they should understand, especially accountants. So let me explain what the so-called tax deduction you're giving up is. It's not even a real deduction. I'm just using that word because that's what they use. Give you an example. Employee makes $50,000. They defer, say, $10,000 into their 401k. Their W-2, the taxable earnings, will net that out. They will only have to pay tax on those wages of the net, the $40,000. So they got so-called deduction. You'd have to give that up. If it went to a Roth 401k, you'd pay tax on the whole $50,000. So a lot of my colleagues say, but you gave up the deduction. I said, you got to look at the big picture. First, it's not even a real deduction. I call it a fake deduction because a deduction to me is something you get to keep. Like you deduct home mortgage interest. You take that to the bank, you keep it. Charitable deduction, you keep it. Medical expenses, if you have them, it's a real deduction, you keep it. They may have a large amount in a 401k and nothing in a Roth part. They should start having more going into retirement. You want tax-free. And why do you want that? My always rule, because tax-free is always better. Nobody has ever disliked having tax-free in my lifetime. In every seminar, I talk about tax-free, and people are all polarized politically. One thing, everybody likes to pay less tax or no tax.
As we're touching on taxes, you kind of say that the math shows that taxes are certainly to rise in the future. So why do you believe this, and what do you think it means for retirees?
Believe in math. I look at these debt levels. They're in the trillions. I don't know what it is now, 38, 39, 40 trillion. I really don't know. All I know is if you have to round up to the nearest trillion, it's a problem. Yeah. So I believe it's going, at some point, this is all going to hit the fan, and they're going to have to raise taxes. It's just a matter of when. So far, even in this current bill, they keep kicking the can down the road. At some point, somebody's going to be left, like when the music stops without a chair, if you know what I mean. And who's going to be hit the most? Who's at highest risk? The people with the most money that has not yet been taxed. And that money's sitting in a 401k, in an IRA, in a 403b, tax-deferred accounts. They're the easy pickings for Congress, the low-hanging fruit, because they made that deal. We made that deal. You got the tax deduction, and that was the deal then, and now you have to pay the piper. So I'm worried about future tax rates.
A lot of my audience is 50s and 60s. What are the things that they can do to prepare for this?
Well, they first have to understand the problem that I'm giving them. And I believe that whenever I do programs, I don't go into the solution right away, because I find most people don't care about the solution unless they believe they have a problem. So I'm telling you, the larger the go get out your statement, and the however proud you are, the larger it is, the bigger problem you have, that ticking tax time bomb. So you have a problem. You have to start bringing that down, and that gets to my next always rule, always true. And it's so simple. It's just people miss it. It's so simple. The way to save the most money in taxes over your lifetime is my always rule. Always pay taxes at the lowest rates. It's so simple, but why don't people do it? Again, they're short-sighted. They don't see the big picture. A lot of my colleagues say, CPAs, we were trained. Remember how CPAs were trained? We were trained to never, ever pay a tax before you have to. Never let a client pay a tax voluntarily before it's required. Always defer, 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 put it off. In fact, if when you were a kid and your mother told you to do something and you said, not now, Ma, I'll do it later, you would have become an accountant because you were trained to defer, to put things off. So that's how accountants think. But this is the opposite. This is why I'm a recovering accountant. This is the opposite of that. You've got to think long-term, big picture. It pays to pay taxes now. That's the secret. That's the secret to all of this. 3 words. I just gave you the secret. Do you know what Benjamin Franklin said about secrets?
What's that?
3 people can keep a secret if 2 of them are dead. I'm going to give you the secret. I just gave it to you, but I'll give it to you more clearly. 3 words to save the most money in taxes. Pay taxes now while rates are low. Always pay while rates are low. If you look at the 2025 tax rates, a married couple filing joint could stay in the historically low bracket of only 24% compared to what it's been for years and still have almost $400,000 of taxable income. It's bizarre. Do not waste a low tax bracket. And that's just the top dollars. You'll still get the 10%, 12%, 22%.
I think that's my favorite quote. Don't waste a low tax bracket.
Oh, that's a federal tax crime to me. Wasting a low bracket. Like I have CPA colleagues, they like to show me how great they've done for clients in meetings and programs we do, and they'll come up to me and said, Ed, I got my client in a 0% tax bracket. I say, I'm sorry to hear that. You wasted all of these brackets. Push the income in while rates are low. So you said somebody in their 50s, what can they do now? First, stop pouring gasoline on the fire. Stop adding to the problem. Stop contributing to 401ks, tax-deferred accounts, or even IRAs, and start taking that balance down while rates are low. And then people will say, but Ed, I don't have to. I'm not required to till age 73. Why would I pay tax before I have to have more later? So when I say the 3 words, a lot of times with consumer audience, I say the same thing I just told you. Pay taxes now. And they look at me, Ed, what kind of accountant are you? Pay taxes now? If I pay taxes now, I'll immediately have less, not more. And then I say, I'm here to tell you the exact opposite is true. Paying taxes now will leave you more and more tax-free when you need it the most. So you take down from your IRA. Do not waste these low brackets. And take down, even if you don't need it, in your 50s and 60s and a little each year, start putting it into Roth IRAs. I'm not saying take it out and buy a big TV or something with it. Put it in a better place. Put it in a place where it grows 100% for you in a Roth IRA.
So really,
yes, you'll pay some taxes now, but this isn't an option. It's not if, but when. This tax bill will have to be paid. So if you can get the money out now while rates are rock bottom low, taxes are on sale. Everybody likes a sale. Take advantage of that now.
So it's not like you're focusing so much on this year's tax bill. It's more taking
That's
the long
right.
view, a lifetime tax bill.
I'm so glad you said that. You asked the perfect question. You know why? Around tax time, I do all these interviews. I don't even know why I do them anymore, because even on CNBC, when they know a little more about finance, but it's mostly the general news shows and things, and they usually have me, I don't even go down there anymore. We do it from here virtually. They would say, Ed, it's April 13th, 14th of it. What can people do to save save on taxes? And I look at the camera and I set it up a little, make it dramatic, you know. Yeah. I said, oh, what can they do and save on taxes? I got one thing for you. Nothing. that year already happened. Unless you have a time machine, you can't change what happened. And that only affects 1 year, exactly like you said, Erin. You have to look at saving taxes has to be a lifetime plan, a lifelong plan. So yes, if I tell you pay taxes now and put it in a Roth IRA and you only look at this year, yes, there'll be less. But if you look over your lifetime, again, the compounding starts working for you, not against you. You keep 100% of that money. And I don't know anybody who has a Roth IRA that doesn't absolutely love looking at their statements, including me, saying, "That's 100% mine. Absolutely. I don't have to share that with anyone, and neither do my beneficiaries."
Perfect. Yeah, I totally agree. I love looking at my Roth balance and knowing, hey, when I get to retirement, that is mine. And I think,
oh wow, I'm impressed. So I have to turn the tables. That's very smart. What made you to go to a Roth?
Oh gosh, I started my Roth maybe 15 years ago. When they first came out,
1998 they first came out.
Okay. When I first learned about them, I've always kind of been a stickler for investing. I started reading Dave Ramsey books when I was in high school. I started reading about Jack Bogle when I was in college. I opened my first Vanguard account when I was 19. Wow. I think I had a traditional for a few years, and then I switched over to a Roth because I heard about, taxes, paying it now and then getting to retirement.
Very smart.
Tax-free. So, I think all of this happened around the time I was 18, 19, 20.
That's brilliant. Yeah. The compounding is all growing for you. So you know that feeling I'm talking about. You take your statement, this is all mine. This is all tax-free. I will never pay taxes. And the great feeling about that is you'd never have to worry about the uncertainty of what future higher taxes can do to your standard of living in retirement. In fact, when taxes go up, and I say when because, again, I believe in math, at some point they have to pay the piper. If taxes go up, anything tax-free like a Roth IRA becomes immediately more valuable. If you have, I used to hold up two cards at seminars, one an IRA and a Roth IRA, and I said there's 100,000 in each of these. Which one's worth more? Well, if tax rates are 50%, the Roth is worth double. So it's very simple, but people miss the big picture because they're focused short term. Just like you say, what can I save now? The answer should be, how much can I get out of my IRA now and stay in a low bracket? And for the people that have this fixation on required minimum distributions, because that's what they're told. Oh, they raised the age from 70 and a half, then they raise it to 72, at 73, I can wait longer and longer. Do you realize what's going on?
It's just going to compound and get larger and larger.
It's growing. What if they raised it to 90? Don't wait. So RMDs, required minimum distributions, the M in RMD stands for minimum, but it doesn't stand for maximum. Change the way you're thinking. Not what's the least I can do. First of all, that doesn't work in anything in life. You go for a job interview, say, I'd like to know what's the least I could do. Because I want to be valuable to the company. Minimum doesn't work at anything other than maybe diets, but other than that. So don't think minimum, what's the least. Think about what's the most. Think maximum. How much can I get out of my IRA or 401k while rates are low, and then I'll have more later.
So let's say someone's already in retirement. They're already taking their required minimum distribution. Let's say they're in the 12% bracket. Would you say maybe take out enough to max out that 12% bracket?
Yeah, because if it depends what their situation is. A different version of that question I get, and I think it's on your list there too. I get questions, I'm 80 years old.
Yep.
Should I convert to a Roth IRA? So I tell them, first of all, converting is a little tougher once you're into RMDs because the RMD itself cannot be converted. See, this is the key to part of the keys along with the other ones. It's out of your control. You must take that. This is why I like the idea in your 50s and 60s, controlling the taxes you pay. You can control it by using the low brackets. But once you're into RMDs, it's out of your control. Now you're on the government plan, so you have to take a certain amount. And that amount, whatever that is, has to be taken, and it cannot be converted. The first dollars out are deemed to satisfy your RMD, so those can't be converted. started. That's what you'd be doing. You're giving a gift to your kids of leaving them a tax-free Roth IRA, because had you left them a traditional IRA, they would have to pay the tax. So in effect, you're paying a tax that if you didn't pay it, they would have to pay it. And they might have to pay a lot more. In fact, I was talking to somebody a couple of days ago, and he was telling me that he's well off. He doesn't need the money, but his mother has this large IRA. He says, you know what I'm doing? I'm giving her money to convert her IRA to a Roth, because the last thing I need is that. I'd rather, in essence, pay at her rate than my rate.
Yeah.
So he's giving her money through the gifts, which you can do, and she's converting to a Roth. I said, just one thing, remember, make sure you're the beneficiary on that account. So what happens? Immediately his mom's RMDs go away, so she has lower income, so lower taxes, and now when she passes, he'll inherit her Roth IRA absolutely tax-free, and the tax was paid at her rate, not his rate. So I call that reverse planning, planning up the family tree rather than down.
I haven't heard of many people doing that, but I love that approach.
Oh, it's a great idea, because, like I said, a lot of the children, not a lot, but some of them are in a higher bracket themselves.
So, I mean, very clearly, the Roth IRA is your favorite account.
Absolutely, and nobody would disagree.
Yeah.
The only ones who disagree are people that are short-sighted, don't want to pay tax now. Now, there are people who it doesn't pay to convert. I mean, it's not for everybody. This is where maybe you have to go see a financial advisor, get the pluses and the minuses, benefits and drawbacks. There are some reasons to keep some IRA money. One reason is to use up these low brackets. You don't want to have no IRA money, because that's the perfect money to use up the 10%, 12%, 22%, and the standard deductions. All those, it's almost free money coming out.
So what about going into retirement with 3 different buckets, so to speak? So you have your traditional 401k, you have the Roth IRA, and you have a brokerage account. What about that kind of plan?
Yeah, that's a good plan, but you've got to manage your risk. This is where, as I said before, it's not even. People are too loaded up in tax deferred, and that's a problem, because that's the way it's always been done. And the older people are in their 50s and 60s, almost always are going to be loaded up with 401ks and almost nothing in the Roth. So they don't have any tax, what I call tax risk diversification. They have all their eggs in a taxable basket, subject to uncertainty of future higher taxes. And they can have some money outside, not even a 401k, Roth IRA, and then regular taxable money like in a brokerage account.
What if I were to kind of look at an ideal portfolio? And I know everyone's situation is different, but let's say I had $1 million in a portfolio. Would the ideal balance maybe be 300 in a Roth, 300 in a brokerage?
You're talking to the wrong guy. I would go almost all Roth, because why would I set myself up? I might do 100 just in the IRA. You know, thanks to the Secure Act, they changed all the rules on this. The IRA used to be a fantastic wealth transfer and estate planning vehicle through the Stretch IRA.
Yeah.
What Congress did with the Secure Act, they made the IRA, and I mean also 401ks, anything tax deferred. I'm just using IRA as an umbrella term. But they made the IRA the absolute worst asset to own, worst asset for wealth transfer or estate planning to kids, because it's loaded with taxes.
Yeah.
And all of those taxes will have to now, under the current rules, be paid under a shorter window. By the end
It wasn't
of
so bad before, being to stretch it out over your entire lifetime.
40, 50, 60 years. So, I love that plan. We used to use that. IRAs for that all the time. It doesn't work anymore. Now, all of that tax is going to come out at the end of the 10th year. These kids are going to get zapped in taxes. So it's a whole different scenario. All I think Congress did is incentivize us to probably do the better planning we should have been doing all along. So it alerted us to do more with the Roth, start moving that money out while rates are low. I don't know how long Congress can kick the can down the road while rates are low. But what's the worst case scenario? People always say, well, what if? What if rates never go up? Well, I find that hard to believe, but all right, let's say rates never go up. Will they ever go down? I don't see that. They might, go up a little, maybe, because I think it's at the point they can't, a shock to the system won't work politically. So they'll go up a little. Look at the big debate where they're having in Congress right now. Well, should I make the top rate 37% or the HARA 39.6? You're only talking about 2 or 3%, and they're going crazy. So if it goes up, it'll go up slightly, or they'll trim around the edges, find other ways to get taxes from you, eliminate deductions, things I call like stealthy taxes. You can't really see them. But the idea of rates going down as remember, as your IRA is growing and growing, building a tax bill. So if I'm wrong about the Roth, here's what I love about the Roth, because with any financial decision, you want the pros and cons, benefits and drawbacks. Worst case scenario, if everything I said on the Erin show is wrong, what's the worst case scenario if you did all Roth? You've locked in a 0% tax rate for the rest of your life and 10 years beyond. That is not a bad consolation prize. You can't beat a 0% tax rate. That's the absolute worst case scenario. So that's why I'm such a big fan of the Roth. But the timing on it, getting that money into the Roth while rates are low.
Yeah, let's talk about that. Let's talk about when the ideal time for the conversion is and what's the best strategy to get it in there.
Well, there's a few of them. And again, this is where you want to sit down with a financial advisor who has knowledge in this area. Not all of them do. That's another scenario. But the reason is this area of the tax code, for some reason, over the 30 or 40 years, has gotten Band-Aids and Band-Aids. It's one of the most complex areas, if not the most complex area of the tax code, number one. So that's bad. But the worst part is many of the rules here are permanent, irrevocable, unchangeable, whatever you want to call it, etched in stone. You don't get second chances. You make a mistake, you can lose your whole retirement account. For example, you do an IRA to IRA rollover the wrong way with the wrong time, you could lose that whole account to taxes. Simple things. So the rules are complex. So that's why I said you want the knowledge. You obviously want to gain the knowledge. I always said that. I said that for 15 years when I was on PBS. And I said, why do you want this? Because you want to be educated. You want to learn more, to be more involved. Ask the right questions, demand more from your financial advisors, and know what's going on, because there's a lot at stake. This may be your largest single asset. This is the money you work for most of your working life. This is something you may only get one chance to make the right decision. Now I forgot your question. What
were some of the strategies they can use to convert to a Roth, or the best timing?
Oh yeah, right. The timing is everything. So, like I said, you're in a lower bracket. So, I'll give you an example. We get a lot of questions because we train advisors. So most of our questions come from advisors for their clients. And the most common one, I have a client who's, a doctor, a high earner, and they're making $700,000-800,000 a year. Should they convert? They're at the top rate. I said, well, you know what? A couple of things on that. People like that, and I've had clients like this for 40 years as a CPA. People like that tend to always be in the top bracket, even in retirement. They have good money habits, they're good savers, they're good earners. But there may be an oasis, a little gap between retirement and RMDs. That's the time your income probably will go down for those years. That's the time to strike on Roth conversions, with the goal being by the time RMDs come around at, say, age 73, you have very little in your IRA.
Perfect. I love it. I kind of think that is the golden opportunity, because most people aren't waiting until their mid-70s to retire. I mean, maybe they don't do an early retirement at 50, but a lot of people are going to retire 60, 65 or something like that. So you do have a few years to work with.
Yeah, you know what the greatest retirement plan is? Keep working.
If you're actively contributing to your account, you don't have to take that RMD.
Right. No, I mean, people say, well, how much am I going to need for retirement? Well, if you have money coming in, obviously, the more years you have money coming in, I'm serious about that, you're going to obviously need less for retirement years. So maybe never. Maybe you'll work till you drop. So that's a pretty good plan. If you can, not for everybody.
If you enjoy what you're doing, it's a great plan.
I bet you'll do that. I could see it.
I very well think I could. I love what I do. Every single day, it's amazing.
Yeah, I could see that.
Yeah. I have an audience that is full of DIY investors, and I want you to know that these are very intelligent investors, so they kind of hold off on going to an advisor. But some of this is complicated, and it definitely warrants going to an advisor, so how can they spot a good one?
Right.
And how can you nudge them into it?
All right, and they may be right. Do-it-yourselfer is good for fixing cabinets and cars and stuff like that.
Yeah.
But when you're messing around with a retirement, your retirement, your IRA is like an eggshell. You break it, it's over. You may only get one chance to get this done right. It's good to have a second opinion, even if you're sure there's just too much at stake here. This is your life savings. But finding the right advisor, I've known that was a challenge. This is why I got into this area. Remember, for years, my early years, I was like in my late 20s, early 30s, I was just doing regular tax returns like everybody else. And I realized back in 86, actually, when the 86 Tax Act came out, I said to myself, wow, these people are going to start, this is when all these IRA and complicated RMD rules came out. This is going to affect a lot of people, and almost nobody's going to know anything about it. And I was counseling my clients, even doing little local seminars, and I realized advisors didn't know anything about that, because back then, and still unfortunately pretty much now, the average financial advisor believes their job is to make you money, like in the market. That's half the job. When it comes to retirement accounts, it's what you keep that counts after taxes. So I always say, retirement, the full deal, is like a football game. In a football game, you have two halves, the first half and the second half. Same thing in retirement. You have the first half is the growing, building, investing, accumulating. And the second half is getting it out. But the problem most people make, and most advisors, is, but people that have saved, they get to halftime and they say, which is retirement, let's say, and they say, look at this, we've got all the money we'll ever need for retirement. And they pat themselves on the back, they go in at halftime, and they think they're done. Meanwhile, IRS comes out, they're playing the third and fourth quarter, they're playing nobody, so they win. So you have to have an advisor that's educated. Yes, advisors can make you money in the market, maybe yes, maybe no, but the market is different than taxes. The market goes up and down. You make money, you lose money, you make money, you lose money. Eventually you make money, it goes up over time. But with taxes, if you lose money to taxes, you're never getting that money back. You lose money on investment, you don't really lose till you sell. It goes up and down. But losing money to taxes, you're never getting that money back. So you've got to have somebody that has knowledge in the second half of the game, in the tax planning for retirement accounts. Most advisors do not. They were trained to gather assets, be kind of salespeople, invest money, have money on account, and that they make money on that money. But a lot of them just don't want, not a lot of them, I'm going to say something which is true, but 99% of them don't know what you need them to know. So you might be saying, if you're watching this Erin show with me, you might be saying, Ed, wait a minute, what was that? You're saying 99% of advisors don't have this knowledge? Are you saying, wait, only 1% do? No, it's much less than that. I round it up. It's bad.
Yeah.
Because they don't see it as their job. In fact, many financial firms and advisors have disclaimers. We don't give tax advice. They put it on their shirt. And I tell people, what do you mean you don't give tax advice? This is what it's all about. Taxes are the single biggest factor that will separate people from their retirement dreams. And I even tell them at every program, you don't give tax advice. If you bring in an IRA, you're giving tax advice. If you advise on a Roth conversion, you're giving tax advice. If you advise on a rollover from a 401k to an IRA, you're giving tax advice. You open up a Roth IRA, you're giving tax advice. So just admit it or get out of the business, because you're going to cost your clients a fortune. So 20 years ago, actually longer than that, I've been doing training for advisors, but we created a group called Slott Elite IRA Advisor Group. You may have heard of it. We just celebrated our 20th anniversary for advisors that are really into the tax planning. They and again, if people don't know me, I'm a CPA, I'm a tax advisor. I've never sold products. I don't sell stocks, bonds, funds, insurance, annuities, all of that, which is why my programs on PBS did so well, because there was no ulterior motive. And I always like that. I've been asked many times, well, if you did, we'd give you a nope. I want to always be able to, and this has served me very well, objective, independent, unbiased information like we're doing now.
That's what this channel is. I don't do sponsorships. That way no one else can influence this message.
Oh, wow. So you're kind of like me. It's a good place to be. I'm very comfortable with it. Yeah, I didn't get the big money and all that stuff, but I got the reputation and the credibility, because I'm giving, credible advice that you could take to the bank.
I
And
always
this-
love examples. Can you give a time of where there was a Roth conversion, RMD, something that happened that was small, done years in advance, that had a huge impact later in life?
Oh yeah, I'll give you one of my favorite clients. And what he did, he got laughed out of school. He took a sabbatical for a year, him and his wife, so they would have no income, so they would fall under the 100,000 and be able to convert.
Yeah.
They converted their 500,000 each. Well, he ended up and put it in a Roth. He died recently, I don't know how recently, a few years ago, I heard about it, with $8 million, all in a Roth IRA, absolutely tax-free. And his teacher buddies would laugh at him. Again, short-sighted. Why would you take off sabbatical, forego all your job income to pay tax?
Yeah.
They didn't see the big picture. That was one of the biggest success stories and both of them had that, by the way. Both of them had that. They did the same thing, and they had the foresight to say, no, we want to be in tax-free territory. And the same thing with me. I had the same thing back in 2010. They changed that rule, by the way, in case most people don't realize it. In 2010, once again, Congress needed money. So they eliminated that $100,000 requirement, qualification. In other words, anybody could convert. And they got boatloads of money from people like me who couldn't convert before. When I did seminars and programs in 2010, and some people listening now, I'll bet said, oh, I went to that, I should have done that. I begged people, CPAs, financial advisors, tell your client, take that deal. It was the deal of the century. In fact, recently I was doing a program for a group of CPAs who should know this. And I said, do you remember in 2010 when I was here and I begged you to take that deal? Well, I took that deal and I converted everything in 2010. I threw out to the group of CPAs, I said, how much tax did I pay in 2010? And they said, well, you didn't give us your rate. Nothing, zero. And they're looking at me, what? I told you to take that deal. It was the deal of the century. Here was the deal. If you converted in 2010, you paid no tax in 2010.
Wow.
You paid half in 11 and half in 12. In other words, the government was so desperate for money, they gave everyone, people like me, an interest-free loan to build a tax-free savings account. And ever since then, since 2010, I've got all my money in a Roth, and I look at the statements now. In fairness, I look back, I have a sheet here. I had a feeling this might come up. In fairness, I'm not an investment guy. I have an investment guy, like I said. I didn't know what would happen in the market. But I looked at the close. The Dow Jones Industrial Average, was about 11,000 at the end of 2010. It's 4 times that. Wait a minute. Where's my little phone here, my app? I'll give you in real time here. What is it right now? 4 times that. As of this moment in time, 44,576. So that 4x gain, all in my Roth IRA. I call that a success story. Now, I didn't know about the investments, but I knew markets go up over time. It goes up and down, but up over time. All of those gains in my Roth IRA because I took that deal.
That's the sweet spot,
Yeah, and I think we have a deal like that now because taxes are on sale.
So what is the best thing that someone can do today? If they have
Oh, wait, let's go back to your other question. I never finished. All I talk about is the problem, that most advisors are not trained on this. So I created this group, the Ed Slott's Elite IRA Advisor Group, as an educational group. I don't teach them about investments. That's where we went off. I said I don't do investments and all of that, which I don't. It's all about tax planning and only for advisors that are totally focused on doing what I'm doing and learning about it. And this is a group of advisors that has us as a back office. We have a team of IRA experts. If they have questions, for their clients, they can call us or email, communicate with us and get the right answers the first time. They're totally dedicated to this kind of planning. This is that portion of the 1% of advisors. Now, they're not the only ones, but they've been exposed to it. And some of these advisors have been in this group, this membership group, for the full 20 years. Most of them have been in it more than 10 years.
Yeah.
Studying, going to workshops, getting the updates, getting our newsletter, just immersed in this. But it's a rare breed to find these advisors, not the only ones, but I know they've been exposed to it. Mm-hmm. And the difference between them and the average advisor, and this is a big difference, they know they don't know everything. They know what they don't know. The average advisor doesn't know that he doesn't know, so he's dangerous. One wrong move, like I said, with the retirement savings, you could lose it in chunks, and it's not coming back. Yeah. So if you want to find these advisors, you can go to our website. We don't get any, they pay us for a membership fee for our educational program. Nothing to do with their investments. That doesn't have anything to do with that. It's all tax planning. These are the guys that say, I want to do tax planning. And these are the guys who tend to have the clients that were do-it-yourselfers, because they realize a lot of the do-it-yourselfers, to their credit, your listeners, your followers, they know more than the average advisor, so I don't blame them. Years ago, I noticed this phenomenon, and I called it crossover point. And I told advisors, you have people out there that know more than you. Well, you're never going to get their business because they're smarter than you. You should be hiring them. And I made the case, you have to know this stuff, and you have to know it cold, because mistakes are irrevocable and expensive. So you can go to our website, which I guess you'll post, www.irahelp.com, irahelp.com, and go to find an advisor. And they're all over the country. There's only about 500 in the whole country. Yeah. Now, out of roughly, I'd say in general, people call themselves advisors, somewhere about 300,000-400,000, maybe more. This is not even 1% of that. It's pathetic. I don't understand why advisors, they're so fixated on the investment, but it's not how much you have, it's how much you keep when you need it after
I always say, if an advisor is just picking like index funds for you, like you're paying someone to do something you could easily do on your own.
That's true. Absolutely. But the tax planning is where the value is. I found that as a tax accountant, like I said, getting into the estate planning, because you could save somebody real money. Real big money. You can do this with the tax planning, and I would say the larger your IRA, the more money you're in line to save in taxes if you make the right moves now and have the guidance, just as a second opinion, of a tax advisor. If you get the right advisor, but you're going to have to grill them. I would ask questions like, when was the last time you went to a program? Here, for example, like this. This is our 2-day program. This is the precursor. We're going to Chicago next week. It's a sold-out program. The advisors that go to this, they get a 400-page manual. We go. Hey,
can I come? I'm in the Chicago area.
You can definitely come. Well, we hooked that up. We have media passes. It's sold out. You're going to love it. You get this book. You will get this book, a 400-page. You will be amazed at what goes on. You will have material for the rest of your life for shows.
Perfect. This will be my nighttime reading.
This is great. But this is just the precursor. This covers virtually every topic, and me and my team of experts present it, and it's fun, believe it or not. It's sold out. They all present like I do, and we have a good time with it. And advisors, the biggest comment we get after the first or second break on the first day, they come up and say, I've been in business 20 years. I can't believe how much I didn't know. Yeah. That's the average advisor, but these people invested. That's another question. Are you investing in your education? Not how to sell stocks. That I can do on my own. Not how to buy and sell and, all of that stuff. And I'm saying that's okay, but I think that's more commoditized. Just like tax planning versus tax preparation. That was also on your list. Yeah. And I realized years ago, tax preparation, doing taxes, is also like investing, I think. Really commoditized. You could do it yourself or get it for free in most places. The difference between tax preparation and serious tax planning, tax preparation costs you money. Tax planning makes you money. Okay. That's a big difference. Yes. And if you get an advisor like that, so people who go to our 2-day, they have to go to the 2-day, the advisors, before they even qualify for our elite level that I told you about. So a lot of them go to this just to see if they qualify for the advanced training. Because what happens there, they go to that program and see how much they didn't know and say, I want to learn more about this and more about this and more about this, and their mind starts going, I can help this client and that guy. Oh, he has this thing. And some of them will run out in the middle of the program and call a client and say, stop whatever I told you, that was wrong.
Hey, well, it's good that they're constantly learning, so that's good.
So that's it. So for do-it-yourself, if you want the serious tax planning, you also have to connect with a serious advisor that invests in their education. I always say, if the advisor doesn't invest in their education in this area, then you shouldn't be investing with them.
Yeah, absolutely. Okay, so my audience,
I know we went off the rails, but keep going.
Very valuable. So my audience is these DIY investors. So let's say a lot of them are on the brink of retirement. Maybe it's 1, 2, 3, 4 years away. What are the handful of things that they can do now to prepare for their retirement?
Well, one of the things, look at your portfolio. How are you lopsided, overweighted, in taxable money? Thinking, well, I don't have to touch this till 73. That's wrong. Start bringing that down and I know it kills you. When Roth first came out and they had to write a check to pay taxes, it was unheard of. Who would write a check, pay taxes before you have to? Some clients came in here at this same desk I've been at over 40 years. Their hands would shake, not because they had a disease, because they couldn't bring themselves to write a check voluntarily. You're talking about voluntarily. And that's how people think. So you have to get over that, knowing you're in it for the big picture. If you're in your 60s, start a plan to use these low brackets. These low brackets are gold. I'm telling you, you'll always have more money if you get it out at low rates. And so that would be the plan. At any age, it's harder once you hit 73 because, like I said, you have to first. Then you're on the government plan. I always say you want your plan, not the government plan. And people that are do-it-yourselfers will like that. If you ask them, you want your plan or the government plan? I want to be in control. Well, the only way you can be in control is to manage your own tax rates. You determine how much tax you pay. And you can do that, say, in your 60s before you're forced to take the money out, even if you don't need it. So that's an important thing, to look at how much you have. If you're lopsided and too much, first stop adding to it. Again, people, like these articles come out. These articles come out, you can put more catch-up because you're 60, 61, 62, extra catch-up, super catch-up. Put it in the Roth. Put it in the Roth 401k. Use the Roth IRA. Stop already building a tax bill, because you're the one, or your beneficiaries, that are going to end up paying more of it, because, again, I believe in that future taxes will have to go up at some point. I don't know when. So far,
I agree with you. I think they're going up in the future. We don't know when, but they're going up.
Yeah, but you don't want to be stuck, whatever that game is, when the music stops.
Yeah.
Musical chairs.
Musical chairs, yeah. So you've worked with thousands of individuals. You've worked with thousands of advisors. What's the one biggest message you would hope everyone would take away?
To see the big picture, the long-term planning with the end in mind. And that's the key to all planning. Where do you want to end up? And nobody wants to end up with a tax bill. Yeah. Where do you want to end up? Ignore this, like the magicians say. Ignore this over here, right? Forget about the taxes. Some people say, what about the IRA charges? It's a blip on the screen. You got to look at the long-term big picture. Where do you want to end up? And 99.99% of people, other than tax sadists, will say, I want to be in tax-free. I want control of my money. I want to keep more of my money income tax-free and pass it income tax-free to my kids, at least even for the 10 years. So if you think like that, it'll change everything.
Perfect. I love it. What about if somebody feels behind? What can they do to catch up?
If somebody's behind?
Yeah.
In their savings. Well, as you get older, you had family obligations. This is a question that comes up a lot, actually, because they're helping the kids, and again, too much with the helping the kids. We coddle them. I'm guilty as well. Get over that. I got to get myself over that. You got to do what's in your best interest. What's in it for you?
It's an airplane mask theory,
Maybe by your 50s, hopefully by your 60s, the kids are out of the house. Maybe they even have a job. I've seen it. It happens. Maybe they even have a job. Start taking care of yourself. Take advantage of the amazing amounts you can contribute to Roth IRAs, Roth 401ks. It works. Catch-up contributions. And you can literally load up tax-free in there if you have the disposable income. And you don't have to do the maximum. Don't let that throw you. Like, for example, you could contribute, if you're 50 or over this year, $8,000 to a Roth. You don't have the full. Do something.
Yeah.
Start building. And you're going to love, you know what happens? It's just psychological. Once you see that statement, like you see your Roth build, you want to put more in there because you know that's 100% for me. Uncle
And it
Sam
becomes a
never-
game. It's like trying to get the high score.
Right, right. And you'll go about it that way. And you'll find ways. I know it's a whole psychological thing for another show of yours where people will start every move they make. No, I can't do it. I need money for that Roth IRA. I want to hit that bar.
Yep.
So that's what you should do. The Roth IRA is the greatest savings account ever created. Absolutely income tax free for the rest of your life, under your control. And when you hit, it doesn't matter what age, there are no RMDs on a Roth IRA during your lifetime. You never have to take that money out. So you're in total control. And when the kids get it, they still have to take it out within 10 years after death. But all of that accumulation will be absolutely income tax free.
See, that's when you get to spoil the kids again.
Yeah, right. Or, no, the grandkids.
The grandkids.
You know, there was an old comedian years ago. I took his line, but I always used it at seminars. I said, well, why do grandparents and grandkids get along so well? They have a common enemy.
It's the parent. I
So
love
if
it.
your grandparent doing it for your kids, like do it for the grandkids. That's what I'm doing now. It's all about the grandkids.
I love that. I'm going to tell my mom that. She can do it for my kid.
Yeah.
So if people want to learn more from you outside of the website you already talked about, what's one book or a video or resource that they
Yes,
can
the timing is beautiful. Not just yet, but we're launching a special. I'm reading this because that's what my team gave me to read. We have a new free consumer. I know we have it because I recorded it with my team of experts, and they're all fantastic. You're going to love hearing from them. A free video launching this summer, but I think it is this summer already, so it's going to be soon. Out of my, I stick to my lane. I know taxes. It's like that old saying, Frank Sinatra doesn't move pianos.
Yes.
I just sing. That's it.
Yes.
You know what I mean? It's called Ed Slott and Company's Ultimate Retirement Tax Savings Roadmap. It's free. It's free on-demand video. I think it's about an hour-long program, although they've been editing it, to help consumers, people like watching now, avoid the most common retirement tax traps. It includes real-world strategies, Roth conversions, all the stuff we talked about, RMDs, inherited IRA, estate planning. And part of estate planning is also beneficiary forms. We didn't even talk about that. That is so critical. People don't look at these things for years. This is actually the entire plan for your life savings. And most people think it's covered in the will. That's covered in this video because we made a big deal. People say, oh, I have a will. No, the IRA beneficiary form overrides the will. The 401k beneficiary form overrides the will, especially if you have different bequests to different people, a blended family. You check that beneficiary form. Some advisors still call me up today, even I mention it every program, every seminar, every show, check beneficiary forms. I'll get a call from an advisor. Ed, I had a client just die. Should I check the beneficiary form? Now they're dead. What are you going to do now? That's too late. Anyway, that's on this video. That's critical. That could save your family a fortune. And there's also, we have these optional deep dive videos and a newsletter for consumers called Keep More Quarterly. Viewers can watch the trailer and sign up to be first in line. All right, so the Erin viewers will be first in line.
I can tell you my audience is going to love that. Like I said, we are full of DIYers over here, and I am consistently blown away by how knowledgeable they are and how talented they are. So
They are.
this will be a great asset.
You know why I tell advisors? I said, these people, because it's their money.
Yeah, absolutely. No one's ever going to care about your money more than you do. That is a philosophy I live and die by.
I totally agree.
Yeah.
No one will care about your money more than you.
Yeah. Well, I want to say thank you so much for being here. It was quite a pleasure and what an honor.
Yeah, it was great. You're great on this. Your show's great, and I'll see you in Chicago.